Hello and welcome back to another video. This video will be part 2 of the Building a Valuation Model from Scratch series. And this time we are going to be building a valuation model for Tesla. So valuations on Tesla are bound to divide opinions due to the almost cult-like following that it's managed to gather and the controversial nature of its business, yet the brilliance of the CEO Elon Musk. I have no doubt mine will do the same. Our aim in this video is to learn how to build a valuation model for a company that is not yet profitable. However, the second aim of the video will be to provide an accurate valuation for Tesla using relative and comparable industry analysis to produce a short story for growth and profitability into the future. I'm going to be doing this rather than doing a deep dive presentation on the company and its long-term economics. Now, the way in which we value Tesla will be slightly different to Facebook due to the obvious difference they aren't yet profitable. We therefore can't apply a growth rate to free cash flow or measure free cash flow as a percentage of EBIT or earnings over a 3 to 5 year period. Remember the presentation in the last video here where I broke down the ways in which you can calculate free cash flow. In this case, we're going to assume free cash flow equals revenue times the EBIT margin minus taxes and reinvestment capex. Here we're avoiding the balance sheet complications altogether, such as D&A and changes in net working capital. To be honest with you, the annual free cash flow doesn't have much of an effect on the overall value. The majority of the present value is going to come and is derived from the terminal value, which is calculated, as we always do, using an EV to EBIT multiple. Now, I'll be producing 3 scenarios scaling upwards in bullishness with each one. This should give us a good idea of what story needs to play out for Tesla and what Tesla needs to be a good investment or bad investment from this point. Now, it will depend on the story that you see playing out. You can see the 3 that I'm running with here and the description of what Tesla needs to be for it to play out. And let's be honest, if you're investing in Tesla at this point, it's because of the growth story that you tell yourself, definitely not because of the current fundamentals. But going back to the aim of the video, this is an exercise you should go through with yourself when valuing a company. It provides you with an extended view and allows you to analyze the different possibilities and the probabilities of scenarios playing out and how that would affect the value of your investment. Now, this template here will be available to download in the comments section as always. I'm going to start copying over the historical results, and as you'll know if you watched the previous video, the forecast period is formulated based off the assumptions here on the right. So once we fill in historical results and analyze future growth, profit, etc., we will have a completed forecast period. So for the assumptions, we are going to do, like I said, a lot of comparable and relative analysis and look at some numbers in the total addressable market and some comparable companies to get an idea of what will sit right with us when coming up with a growth story for Tesla. Now, as I copy over all of the historical results here, I've sped this up as it takes quite a long time to actually copy them all over. I'm using Yahoo Finance. As I said previously, I'll tend to do it for a widely followed company like Tesla or Facebook in the video that we did previously. So just copying them all over, I will quickly just talk through the free cash flow part up there and how we're using it differently in this valuation. So we're going to be using obviously the sales to capital ratio to come up with an expected capex each year. So that sales to cap ratio hasn't filled in at the moment, but essentially what that will do is that will give us a number and tell us how many dollars of capital isn't it, or sorry, how many dollars of revenue Tesla can get with each dollar of capital invested, and that gives us obviously our formula for free cash flow by taking reinvestment capex and deducting it from the EBIT as well as tax. Okay, now let's get a full view of the model as it is. So we have filled in the financials. Now the next step is to come up with our assumptions, which will allow us to get a full forecast period, and then we can move on to the actual DCF valuation. But before we do that, let's slide over here. This will be our analysis section of the spreadsheet. Here I have some data on comparable companies in the auto industry as well as comparable tech companies, for which I am going to be using the FANG stocks, or plus Microsoft FANG M if you like. We're going to use these to come up with a realistic or base case growth story for Tesla. So as you can see, the car companies here tend to have higher revenues than the comparable tech companies, but with much lower margins due to the high cost of producing goods. Tesla we've got it here, is actually currently a small player in the auto industry when compared with the likes of Toyota or Volkswagen or even Mercedes, meaning it has plenty of room to eat up market share if it can execute the right strategies. You can see the market value for the auto market is 2.46 trillion, so just a really huge market. Tesla making up shy of 1% of that at the moment. However, why I've got these tech companies in here is we've always got that argument with Tesla that it's not just a car maker, it can be classed as a tech company as well. And fine, let's factor that in and assume that that could be the case. Tech companies will tend to have smaller revenues because each sale doesn't account for, $50,000 like automakers do. They do, however, have very low cost of production, which means that they beat automakers hand down in terms of earnings and their EBIT margins. The average margin for the selected FANG-M companies is 20%, beating the average for the comparable markets, for the comparable or selected companies in the auto market of 6.9%. However, there are distinct and obvious differences with the two industries, and therefore obvious reasons why Tesla shouldn't just be able to take the best of both sides in both auto-like revenues with software or tech-like margins, and we'll get into those in a moment. First, let's use the data that we've got here to decide on a story for Tesla going forward, and then as we go through we can start to fill in our assumptions here, and we will then see pretty much a full valuation model behind us. If we start with growth, so the Tesla growth story, I find it helpful to look at real dollar amounts when thinking about what Tesla could be in 10 years' time. In terms of comparable companies, I've got some down here. So rather than just applying a compound annual growth rate, this gives us an idea of the heights Tesla would need to reach in order to be a, say, BMW, Mercedes or VW of the world, or even a Facebook or Google if we're thinking in tech terms. Elon Musk has actually gone so far to say that he can grow Tesla at 50% annually, and if he can do this for 10 years running, this gets us to about 470 billion of revenue in 2030. I personally think it's unlikely he'll continue to grow at 50%, but a lot of people have strong beliefs in Elon Musk. But Tesla's revenue stream, especially into the future, will not just include auto sales, but also energy, software, data services. You may think then that the future margins and revenues should definitely reflect this, but we've got to remember that it's likely the majority of Tesla's revenues will always derive from selling cars, as the other streams cannot deliver the same sheer volume of revenue, even though they may be more profitable. So we've got to decide what sort of number do we think Tesla can get to in 2030. Do we think it's going to be a Peugeot, probably bigger than that, maybe a BMW-like revenue, Mercedes, or even Toyota? So here the compound annual growth rates they would be applying if you thought it was going to be, say, a Mercedes at 22% or a BMW, say, 15%. And also these are revenues of these companies now, not in 10 years' time, but it's not a fast-growing industry. As you can see, the compound annual growth rate's only 3.5% currently, so they're not going to move much from this in the next 10 years, although they will grow. Next, the profitability story for Tesla. So as we estimate profitability, it's important to keep in mind the above that we just went through. Tesla will no doubt create larger revenue streams from tech plays such as software and data than other current auto companies. However, there is definitely a give and take dilemma here. So if Tesla is going to produce FANG-like margins, the average of 20% or more, then it needs to primarily become a software and data services company. If that is the case, it's likely it will not have revenues like the big car companies, like Toyota and Volkswagen, or even Mercedes for that matter. And why is this? Because for companies such as, say, Microsoft, Facebook, or even Google over here, their cost of producing additional units of goods is almost zero. Even with Apple, which is primarily a hardware company, it manages to produce an iPhone for 30 to 40% of what it can sell it for. And unless we have some dramatic and really dramatic changes in how efficiently, car companies, even Tesla, can produce a car and then sell it on for the same amount of value, I don't think we're going to see Tesla produce these sort of margins. Even in the energy business, it doesn't tend to be as high margin as, say, software or digital advertising. But credit where credit's due, it doesn't look like, and I can't see Tesla, being the norm in terms of auto companies, but I also don't see it producing, say, like a Microsoft or Facebook margin within the 30s. Even the 20s is hard to get to. So I think meeting somewhere in the middle makes the most sense to me. And that meeting in the middle means that we get about a 15% profit margin for Tesla into the future. Now, the next part is important in calculating our free cash flow, and this is going to be Tesla's investment or capex efficiency, which will give us our sales to cap rate that we want to run with. It's interesting when you look at this. You think software companies are a lot more efficient in investment than the auto industry. However, it's not really the case, and mainly this is due to, it's a little bit of a fix in the numbers, and it's mainly due to the fact that, like we mentioned earlier, revenues just tend to be higher in auto companies, so their margins may be lower. So if we were looking at it in terms of a return on invested capital, where we measure with net income, their percentage would probably be a lot lower than software companies. However, we're talking about the revenue, so the top line that will be generated off of the invested capital. And auto industries in the top quartile or most efficient, they tend to get about 2.5. So essentially that's telling us that auto companies, the efficient ones, can produce $2.5 of revenue from each dollar of capex. And with the expectations around Tesla and Musk's efficiency, I think it would be fair to estimate they will be in the top quartile of efficiency in terms of investing for growth. And we can already, if we go back, start to see that happening over the 4-year period that we have here. It's gone from almost being in negative territory for sales to capital, going up to 1.5. So I think it could be fair to say that they'll reach that 2.5 mark. I don't know if we'll get any higher than that. We could go with a 3, but I think it's fair to just keep it at 2.5 in this case. Like I said, the annual free cash flow isn't making up a huge chunk of the present value here. It is mainly the terminal value that is going to make this amount up, which is nicely leads us into our next part. So we've got some comparable market valuations here. Obviously, if we look, Tesla has an astronomical value put on it as they started to produce, some sturdier margins in the trailing 12 months. We've got 400 times EBIT. I mean, see that jump just from 2019 to 2020, 84 to 695. I mean, what a huge jump. Really has got some huge valuations on it. Let's think about the future valuations rather than just what it's valued at today, although today's valuation is very important. We'll get to that in a moment. Auto industry average 24 times EV to EBIT. I should probably put that in there, that it's EV to EBIT. Auto industry average 24, but that's obviously a slow growth industry, 3.5% compound annual growth rate. US market, excluding financials, around 23, average growth rate, fairly slow. And then I've got some of the, mature but growing companies over here and their valuations for EV to EBIT, which I'd done quite recently, some of the other ones. Across the board, we get 27 times. Now, as you can see, I've got it in here already. I've gone with 30 times for Tesla. I just think as long as that growth rate in years 5 to 10 doesn't really slow, I think Tesla's always going to be getting a premium to the rest of the market. So anywhere between 25 and 30 times, or 27 and 30 times EBIT, I think in the future is probably a fair estimate for Tesla. Okay, so let's plug in some of the assumptions with the story that we've got here. So if we have a Mercedes-like story where we think in 2030 it could reach 200 billion in revenue, and I think that's quite likely if they can execute on the strategy right. We'll go with 30% in the next 1 to 5 years, with that slowing to 20, or sorry, we should probably go with 15. Let's try and get that average. Yeah, so that's the 22% compound annual growth rate. We go from 30 to 15%. Years 1 to 5, 10%, I think, and then we'll get to that meet in the middle range that we spoke about for profit margin, getting us to 15 in year 5 to 10, which is going to be, that's what matters most. The profit margins in year 1 to 5 don't matter too much in terms of present value. Sales to capital ratio 2.5. Like we said here, they're going to be in the efficient quartile of automakers. Federal tax rate of 21%, won't play with that much. And then Cash growth, I've just gone with 15%, as they're going to be growing. They're going to be turning profitable. They will get proceeds from raising capital, which they're probably going to do. Debt, I've put growing at 5%. They tend to go to the market for raising capital rather than taking on debt, as seen recently. Their debt was overhauling their cash by some way, and now it's started to level out. So I think as they mature slightly and become more profitable, cash will outgrow debt. So we'll keep that with 15 and 5 respectively at the moment. Increasing shares outstanding, they're definitely going to increase shares outstanding over the period. I've just gone with 0.5% because with the market valuation at the moment being 500, we've got 650 billion, a 1% raise in shares outstanding means that they can raise 6 billion in cash. So, that market value just means that moving the needle on increasing shares outstanding is harder to do. So I'll keep it at 0.5. That grows it a little bit. That grows it a fair amount over the period. And then our terminal value multiple, as I went with there, I'm going to go with 30, 27 to 30 times. I think is fair to run with on this base case, but we'll just go with 30 for now. And let's see what we've got. As you can see, 22% or 23% compound annual growth over the period. That gets us to that Daimler-like or Mercedes-like revenue of 200 billion or 200 plus billion in 2030. And then with an EBIT margin of 31 billion, which is a 15% overriding. On that, free cash flow, as you can see, is calculated using the sales to capital method. We've gone with 2.5. That gets us to positive or consistent positive free cash flow in 2026, so after 5 years' time. I mean, they're already profitable now, but like I said, this will balance out over the period and hopefully give us an accurate amount when we think about the total. So a total of 5 billion in free cash flow over the period when we factor in the negative cash flow and the positive. Shares outstanding growing slightly, cash growing slightly, getting us to about 58 billion in cash, 25 billion in debt over the period. As you can see, they're currently growing at 44%. So for them to drop to 30% seems reasonable. They might even keep going higher than that and then drop 15% over the 5 to 10. That just gets us to that Daimler-like revenue, as I said. Now, terminal value. Our terminal value is made up of an EV to EBIT multiple. As I mentioned, we've gone with 30 times 2030 EBIT, which gets us to a market cap of nearly $1 trillion in 2030. That gets us to 946 billion. They're not far off of it now, so I know that the DCF isn't going to come back really saying that it's a great investment, especially with the discount rate that I apply. But let's look at that now. So we've got the enterprise value. To get our market cap, we're going to have to less the debt plus the cash in 2030. As you can see there, that gets us to just shy of $1 trillion in 2030, share price of 995. Based on a discount rate of 15%, that's telling us the intrinsic value of all of those cash flows today is $218 billion or $221 per share. Forget about the margin of safety for now. If we go with a more basic discount rate or average discount rate of 10%, that does push the needle a little bit. $353 billion, 358 per share, but still doesn't quite get us to what we want. So based off of this base case valuation, it is telling us that, and obviously it has its flaws, of course. I just wanted to demonstrate how you'd create a valuation model for a company that's not yet producing consistent free cash flow, consistent earnings. But based off of this, it's telling us that Tesla is very much overvalued. And we have got some bullish assumptions here. But again, 22% compound annual growth rate over the period and getting to, some nice margins towards the end with a fair, in my opinion, a fair exit multiple. It really is hard to make those numbers work. Now, it's a difficult situation. This sort of gives us an indication without running an IRR. This tells us what sort of return we would expect from Tesla if we were to buy today and these story assumptions here were to play out. If we apply a discount rate of 4%, we get to an intrinsic value that matches the share price today. So, unfortunately, if you bought today and this story plays out, you're going to be looking at around about a 4% return. Okay, so I've done a scenario 2 here, and the main changes I've highlighted are the compound annual growth rate. So the top line growth rate, we're saying they're going to grow at a quicker rate, or sorry, they're going to grow at a higher compound annual growth rate. Also, we've changed the EBIT margin to say they're going to be slightly more profitable towards the end of the period. So this case is a bullish case, called really the one and only techie car company, meaning that they're not going to have much in the way of competition. So they're going to be able to achieve a lot of growth, and they're also going to have tech-like margin. So this is a 20%, 27% compound annual growth rate over 10 periods with a 17.5% profit margin. Won't be easily done. So its revenues close to Toyota and Volkswagen at the moment, at 314 billion of revenue in 2030, with profit margins like a tech company. So very bullish. And again, you can see we still don't get to the current market cap, and you know these are really bullish assumptions. It just shows it's really got shot up in price, and it does make it hard in terms of getting the numbers to work. Let's look at scenario 3, which we're branding the ultimate company, which basically is the story will have to be that Tesla dominate the auto market, overtaking Volkswagen and Toyota in terms of market share. Gets them to about 569 billion of revenue in 2030, which is almost what Elon Musk thinks he's capable of. That's a 32.5% compound annual growth rate over the period with a 20% profit margin. So revenues like no other auto company. So it's leading the pack. Trails only Walmart, not just auto companies, sorry, trails only Walmart in terms of revenue. All right, try and wrap your head around that. And profit margins like a Google. Sorry, exit multiple higher than the FANG average. So it's still, after all that, going to be selling at a premium. And to be honest, for good reason. If it does manage to do that, there's no reason why it shouldn't be selling at a massive premium to the FANG stocks if it can grow at that amount for a sustained period of time. Again, we just about, off a required rate of return of 15%, we just about get to an intrinsic value for Tesla of 650 billion, which is around the total market cap, based off of this very, very bullish scenario. Which basically means that Tesla needs to be around $3 trillion market cap or enterprise value in 2030. Now, if you're not comfortable enough with that and you're even more bullish than that on Tesla, I have done an extended or fourth scenario. Sorry, I should change that to 4. The even more ultimate company, taking the best of every world that we can. So Tesla dominates the auto market, again overtaking VW and Toyota in terms of market share, and does the unthinkable in terms of efficiency and profitability. This is a 32.5% compound annual growth rate, but with a 25% profit margin. So we're giving it profit margins that exceed the likes of Google and are higher than Apple, similar to Apple, with revenues, like no other company apart from Walmart. Exit multiple, again, I'm keeping it at 30 because I think it's silly to assume a higher exit multiple than 30 for any company, in a 10-year, after a 10-year period where it's going to more or less be a mature company. It is the more volatile part of the valuation, so I'm going to keep it as is and focus more on the actual underlying business results rather than market valuation. This actually does. So this, I know it's very, very bullish, and I've got to say, in my opinion, this is a really, really unrealistic scenario which won't happen. But I just wanted to demonstrate how hard it is to get the numbers to work here. That gives us an intrinsic value of 819 billion for Tesla today. All right, but they need a market cap of over 3.5 trillion in 2030 for this to make sense. You could say this one, scenario 3, is quite unrealistic as well. I don't see it playing out. I don't see them getting Google-like margins and revenues that far exceed the dominators of the market in VW and Toyota. Like we said earlier, there is definitely a dilemma here where they can't just have huge amounts of revenue and higher profit margins, because there's got to be some give and take between, whether they're going to be an automobile company or they're going to be a tech company. If you ask me what I think plays out, it's probably something between scenario 1 and scenario 2, maybe even scenario 1, to be honest with you. Scenario 2, which still doesn't get us to our intrinsic value or to the market cap, an intrinsic value that's near the market cap today, is such bullish assumptions. Even with this, I mean, at 27% 10-year compound annual growth rate with tech-like margins I mean, what more can you want from them? It just shows and demonstrates the danger of when the value of a company does run up as much as Tesla has. I mean, it doesn't matter how much, you love Tesla. I really like Tesla. I think Tesla's a great company with huge potential in terms of, growth and opportunity and disrupting not just the market, but the world in general. But it's so hard to make the numbers work at this point. And to be honest with you, we don't want to be making the numbers work. The numbers have to work for us. It's a dangerous situation when we're trying to make numbers work. Okay, I thought this would be a good way to end the video if we look at a distribution of all of our valuations or our assumptions. We've got a base case, a bullish case, the ultimate company, which is a very tough ask, and the even more ultimate company, which is more of the unrealistic scenario. All of them, we're buying them at 650 billion, and I've taken out the free cash flow amounts for this and just focusing on the purchase price versus the exit multiple price as well. As we said earlier, the majority of the present value anyway in the DCF is coming from the terminal value rather than the free cash flows. So if we just jump in the base case that we've got up here, where we sell the company or we can exit the company at 980 billion, so just shy of $1 trillion in 2030, based off of revenues of 210 billion and a profit margin of 15. That's only an IRR of 5%, a very poor return. The bullish case scenario, still quite a mediocre return, going off of 315 billion of revenue with a 17% profit margin. So Volkswagen Toyota revenues with tech-like margins, selling it for 1.6 trillion in year 10. That still is an IRR of 11%, quite mediocre. And the ultimate company scenario, scenario 3, which again is going to be a very tough ask for Tesla. That gives us a terminal value of 2.8 trillion. Okay, and revenues, that's based off of revenues of 460 billion, profit margins of 20%, and that just pushes us above what would be my minimum acceptable rate of return, which is 18%. And then scenario 4, the even more ultimate company, which is, I've got to say, a very unrealistic scenario. That gives us an IRR, it just pushes it above 20%. I thought that's the reason why I wanted to put it in there. So if we're being that bullish on Tesla, that only just pushes us above a 20% rate of return with no sort of margin for error in there either. Tesla would have to be worth 3.5 trillion in year 10 for that sort of return to play out. If you ask me what's the most likely case, and in my opinion it's going to be somewhere between these two. If you told me that the base case was going to play out with a 5% return from this point, I really wouldn't be calling you a liar. I think it just demonstrates the danger of when a stock has run up in price like that without the fundamentals really backing it up. Tesla has a brilliant story behind it, and who knows where the stock's going to go in the next 6 months or even a year, to be honest with you. But going over a 10-year period, which is a long-term hold, allows us to have a better estimate in terms of how good of investment it will be. All right, usually over a long-term period, the stock's performance will reflect the underlying company's performance, not the market's valuations over the long run, that is. Personally, I think there are better places out there to put your money and bet on than Tesla, although I feel Tesla is a brilliant company, and not only is disrupting the market, the auto market, it's disrupting the world. It's just the law of large numbers starts to work against you somewhat when you get valuations shoot up to something like 650 billion with no real fundamentals to back it up. Anyway, let me know down in the comments below what you think of Tesla and what you think of the valuation. As I promised, I will leave a downloadable template of that Tesla valuation in the comments section so you can have a play around with the numbers and even change it yourself if you have a different scenario playing out in your head. Going back to the aim of the video, hopefully it gave you a good idea of how you can use a DCF model or create a DCF model from scratch to value a company that is not yet profitable. So as you would have seen, two slightly ways of valuing the company in terms of predicting the free cash flow. That's the main difference, with the Facebook one we did in the previous video and the Tesla one now. If you're listening, thank you for making it this far in the video. If you enjoyed it, please leave a like and subscribe, support the channel, and I will have some more videos coming out very shortly on some other companies. If there are any other companies that you want done, then do let me know in the comments. But until next time, good luck with your investments.